we're coming up to a level that's interesting. It's a little bit of I wouldn't call it a resistance point. The inventory is so small today, as you'll see. I'm actually kind of surprised that the straddle is so low at $31, 46 basis points, around 67.95. It seems cheap to me, considering that all we have below is a stretch of what I would usually call a void, meaning there's really nothing there, no positioning really bigger than 1,000 either way until you get to 67.20. And I want to say almost all of the strikes are held short net. And the only notable long is actually just the middle of a customer long put fly. So not a whole lot to talk about in terms of like actual levels and ranges. Just know that there's a little bit of a test coming up at 6,800. Very weak balance at 67.90, which is what we've actually observed for most of the, I guess, morning until now, and a risk below. So the type of profile where we have a positive speed backdrop returning to the market because of the positioning, but I would say a pretty delicate one in that I'd actually be more confident in the rally if there were more customer hedges below spot. But I'll show you guys in a second. So pushing 6,800, I would imagine we start to see the VIX no future start to floor, only because I don't believe it has room to go too much lower in all this movement. Obviously, you know, too, that these big moves either direction, up vol is still vol as well. So to the extent that we have big moves to the upside, remember the settlement on Friday was 67.2880. So right now, this is realizing about roughly a 16 vol. Higher than you probably want to see sustained if you don't want vol control types of entities to deleverage. So today and tomorrow should be interesting. Usually these days would be, in my opinion, lower volume days. Obviously, whenever you have any kind of partial closure or situations where the market's open, but a lot of entities are off or bonds are closed, that tends to have impact on volumes overall. We'll see, obviously. Don't know what to expect exactly. I don't know what to expect for the government shutdown voting process. If anybody has anything concrete, feel free to share it on the server. My perspective so far is that this is maybe the market's getting a little bit ahead of itself because now we have headline risk alongside kind of a void to the downside. So when I look at this profile and the general Greek that it produces here, upside gamma getting longer, downside gamma is neutral to short. When I look at this, I think, okay, the most reasonable way to play for continued upside is a fly, most likely. We have some pretty strong balance implied at 68.15 and then really a hard stop at 68.5, which would encourage something like a call fly around 68.15 with the center. I don't see 68.5 as having any kind of charm influence. It's just too small of an option on the straddle. 5 delta call at 68.5. Okay. So good rule of thumb is just to take the straddle price and add and subtract that from current spot levels. That gives you almost the 1 standard deviation point. I think it's actually a pretty good heuristic for understanding where charm is going to come from because it's just inside the 1 standard deviation point. So it might not be peak charm, but it's actually on the right side of it through the lens of like understanding what the next peak charm is, right? Because the influence will peak, but then from a strike space perspective, meaning if you're thinking about charm being strongest at the 20 delta areas on the distribution, if you hold strikes constant and look at where those points are from the 20 delta perspective, you want to shift from those strikes inward to think through what's coming next. Hope that makes sense. I didn't intend to confuse the process there, but I'll show you guys today. Charm looks pretty bullish today compared to what we've seen overall. Remember, this level here is something that we've seen over and over, but this is so far gone right now. That's 70 points to the downside. You have to zoom in a little bit and look at the range that we're actually in, and it's all bullish. That's not to say we can't experience the opposite. Obviously, Friday was a good example of experiencing the opposite. It reminded me of some of the price action we had in March. We had a very strong suppressive charm profile, which also always needs to be respected as the opposite of a negative speed profile. Fancy way of saying that when the market goes up, it goes up faster. When it goes down, it goes down slower. So the movement to the downside and the idea about trading a put fly was to capture the idea that to capture the hypothesis that maybe the market, the straddles are rich a little bit. Buying a fly is a defined way of selling options while actually giving you positive convexity in the form of a higher like payout ratio if you're right. The expression though relies on the market to slow down and to kind of get stuck and trapped in a positive gamma and a pinning process eventually. Now, when that is met with heavy flow in the other direction, the flow in the other direction actually can get through a range faster like we saw on Friday because to produce this profile with charm the way it is requires a little bit of negative gamma to the upside typically, which is exactly what we saw. A great question to VS Pro. Somebody said, what was the hypothesis for holding on to the fly? Why did I hold the fly instead of abandon? When most of the time I would abandon. For example, there were a couple of tests on Friday's profile. I thought 67.90 was a test and 67.5 to 60 was another test. We punched through and found some kind of support where there was positive gamma around 66.25 and 66.30. And then when we recovered 66.5, we never really got sucked back down into the heavy charm down area on the curve or the surface. And so generally speaking, you'd want to probably close then and there, and you might be able to close like a losing hypothesis, meaning that the fly didn't pay out in the way you expected it to pay out, but you might be able to close for a profit at that point. On Friday, though, I was kind of also assuming we might get a reversal due to what was flagged as potential AP selling at the close. But clearly the AP buy order that RTM flagged and all the boxes up dwarfed whatever flow was coming at the close. And at a certain point, it just felt like the trade was too small premium to exit from my perspective. Obviously, you guys need to trade whatever makes sense for you guys ultimately. But again, it helps to think through the what ifs, right? So a situation like Friday, where there's a massive negative gamma range to the upside, positive gamma to the downside, which compels passive selling towards the downside, but also risks fast movement to the upside. Just geared towards what structures make sense, right? If you're looking for upside, single legs might work better, especially if the straddle gets cheap. If you're looking for downside, even if the straddle is kind of cheap, spreads and flies, especially flies because they net sell options into the area where you expect to go, are cheaper ways to express your view and are more likely to pay out based on two things: the directional imbalance, but also importantly, the idea that you're selling options into an area where you don't expect options to quote unquote perform. I would say charm is not, there's a couple good questions here. I'm gonna go through them. Tomorrow, Veterans Day, banks and bond markets close. So yeah, there could be, it's hard to make sense of what to expect on Veterans Day. I would treat this like a lower volume day tomorrow, that is, and orient accordingly. And then as far as this question, is the charm mostly coming from monthlies and quarterlies? I would say at any given time, charm is always going to mostly come from what's expiring today. If you guys look at a charm profile that's constructed only of monthlies and quarterlies, it would look so minute, even with very large positions, compared to what happens when you have 0-day options expiring every day. Because obviously, if you even just think about pricing a time spread, for example, if you look 2 weeks or 3 weeks out in the future and just price a horizontal calendar, you're going to see a delta difference of maybe 1 on the option. And just wrapping your head around that, that's saying that over the course of a whole day, you might get a 1 delta decay on that option at that strike. And so you're going to have really big concentrated positions to produce a visible tradable impact when you're looking at positions that are far enough out in time, because the Greek just is not that strong yet. Hopefully that makes sense. But so just to drive this point home on this position, because I think this is kind of important to understand the shapes here, right? So we have what looks like a test at 67.95 to 6800. The straddle, I believe, is roughly $31, 32. Okay, it's gone up just a little bit since I pulled it before. In my opinion, this area is kind of key to hold and extend through in order for us to kind of see some option selling, maybe even some failed attempts at trading lower. Some ideally the way this will work is you see a bunch of newly opened long puts on the customer side, and those opening puts don't actually have enough push to get us through any real downside levels. Then the next thing that happens is the decay process encourages the passive drift higher. It provides an ironic kind of lift to the market as the hedge that was initiated, causing like that erratic movement in the open, is actually kind of then just bought back over the course of the day. That ironically produces more support, but again, you understand too that it's a negative gamma through the range. The difference though is that oftentimes when you have negative gamma through a range and it's opened intraday, you can expect that the customer is going to come back and close. When you see structures like this that are present going into the day, it's less likely that the customer, whoever holds this, is going to trade it the same way that we trade intraday. So this usually, in my mind, means it makes for ranges that extend longer, which I guess in some form or fashion, we've already experienced this overnight, right? The close Friday was here. Within, I think, 10 minutes or 20 minutes of close, we were trading 40, and it was just right through this entire range. And this is a little bit misleading too. If you think about what's happening here on this put fly, look at the sizes. These are all small sizes for one, except for a couple of big anchors to the upside. This 10,000 lot is probably part of some structure that's a wider condor. Yeah, there you go. Here's the structuring. This is a more well-capitalized structure than the David Chow group, obviously. But this is pretty far to the money right now. It's just going to be a hard stop. It's very difficult for the index to get through these levels overall, at least in the sense of, when we reach them, there's a lot of minis implied for sale. Take every one of these values and multiply it by 2. That's how many futures you'd expect to be sold, basically, when we get there. So here we have 20,000, 35,000, 45,000 minis implied for sale just by gamma hedging alone between these levels if we get there. So don't assume that is anything that's attractive or magnetic. It's actually just a stop right now. And what's more important is understanding that there probably is a little bit of magnetism here. This is the only level that makes sense to me to look for a pin or an area of weak support and stability that the index might be able to hold on to through tomorrow. And then here, I take this out mentally. Hopefully you guys understand why. If you think about what's going on in the structure, it's very narrow. Now, obviously, just like the David Chow iron condors, people may play these strikes. They may look at this and say, oh, there's a level here. But from a market maker's hedging perspective, if you want to be technical, as I think you should understand the difference, this doesn't produce any hedging impact. If the straddle is very, very cheap, like $5 or $10, and we're local, meaning we're trading around these strikes, then it's going to have some variable impact, and that'll show up in the charm profile and the gamma profile when we're there. But for the moment, if we did sell off, you can almost remove this from the position, because a 5-point fly, or sorry, I guess a 10-point fly, centered around 67, 65, there's just no Greeks to this. And so there's no hedging influence from a market maker's perspective that's actually tradable. That's actually going to show up, especially on a position this small. And when you remove this, it actually creates an even stranger looking picture where there's almost nothing below the market. And I say voids are almost worse than negative gamma profiles because at least with a negative gamma profile or a short options position on the dealer side, it implies a long options position on the customer side. So a customer may be hedged, right? And there might be a reason for a customer to step in and buy a falling market if they're well protected. But if there's nothing there, nobody's really prepared for anything. And oftentimes, ironically, even though the straddles might not reflect it, we can run through these ranges of very light inventory much faster than negative gamma. I would say to this point, about to be fair, we're driven by flows in either direction. That's always going to be the case, right? So we have a conditional and we have some drift. And conditionals are sometimes, like Friday's a great example of a conditional, right? When RTM flagged big buying, that was a massive program. Like a huge amount of spies were probably bought notionally throughout the course of the afternoon. That's something you can't predict outright. You can only spot when it's in motion, maybe. Yeah, I would agree with the bound above at 68.5 because it's kind of a hard stop. And I say hard stop because most of this process is continuous. But if we rally quickly, we're going to be taking options that have very little delta, like sub 10, sub 5. And suddenly they'll be pricing on the surface and selling will ramp up relatively quickly. Depending on what time of day that happens, it's either gradual or sudden. And even on a sharp rally right now, it's going to look semi-sudden. It'll flatten out price pretty quickly if we get up there. But yeah, to this point, low inventory suggests no speed bumps. That's kind of a good way to put it, I guess. It just leaves for a very wide range of possible movement. And so this is a skewed profile, even with the government, resolution kind of imminent. I don't know what the process is for, like, whether there's any chance of seeing a resolution today, like a firm resolution. It doesn't sound like it. Probably, I've seen some indication that maybe Wednesday there'll be a vote that makes it final. So even on, marginal positive headlines, this profile says there's a stopping point ahead. There's pretty strong resistance, absorptive flows. Whereas the downside, anything can happen. It doesn't even take a lot to really make it move. And so then if you're thinking about downside expressions, single legs make more sense. And upside expressions, you'd want to cheapen that with things that don't need as much distance to pay you. That's all. Cool. 10 more minutes. I'll let you guys go for now. It looks like we're holding 67.90. I look at the profile. It says 95 to 800 is a good place to expect some drift to eventually kick in. But still, we're kind of in reversal territory. So just beware. I don't know what to expect out of the gates. Obviously, I look at the profile and the gamma perspective says we are coming into a long gamma profile in this range, but by no means is this long. 75 gamma is basically flat. The long gamma profile is actually kind of misleading because it really relies on us getting up towards these iron condors. And you can see this is the influence of speed. It's probably too small to tell, but as I roll my cursor up, the gamma number here goes from like 50 to 75, 150, and then quickly it starts to grow. And this is still early in the day to levels approaching 700, right? And then you go towards the close, it's going to be massive. So that's the hard stop I'm talking about, and that's really how it works. I say this because I don't know what to expect if we expect extension on the open. That's probably my base case. Like there's probably some negative gamma hedging that needs to be shored up, or reversal. But reversal would usually happen if we have a big move against a very overall long gamma profile, which is not the case right now. So Good luck. If you have questions, just ask them. I'm going to be a little bit less available today and tomorrow specifically because we're getting close to launch. I'll need to do a lot more like careful work and meetings outside of trading. I'll be in RTM as much as possible. Yeah, Cheese, that's what I was saying. I don't really know what to expect with mean reversion out of the open. It's not really clear to me. I would probably expect volatility at the open and a better chance for a little bit of extension than mean reversion. But we'll see. We'll find out together. All right, cool. Good luck.